Hello and welcome everyone to Capital Trends. We are going to talk about a very hot topic. I mean, really straight off the oven. Formidable trend of electric cars. After the global shift towards ESG, net zero, sustainability, carbon neutrality, and a talk about reducing the reliance on fossil fuels, shifting towards adoption of electric cars have really garnered a lot of attention. Each and every car maker is launching myriad of models and advertising them in grandiloquent stage show, unveiling new features and competitive technology behind these robots. Yes, I really mean robots. Haven't you heard Elon Musk saying that Tesla is less of a car manufacturer but more of a largest robot manufacturing entity? So let's dive into the history. Electric cars are around us over 100 years. Yes, you heard that right, 100 years. In 1899, in the outskirts of Paris, electric car was the first to reach 100 km per hour. But with the discovery of oil combined with cumbersome battery technology, the internal combustion engine dominated for the next 100 plus years.
Before we dive into electric vehicles of today, I think it's worth taking a step back and going through hybrid vehicles. Hybrid vehicles have the same combustion engine like a petrol vehicle, but with added smarts, it can save fuel for some operations like running idle and harvest energy from operations like braking. Hybrid cars are extremely popular among people who are looking for efficient, environmental friendly, and of course affordable cars. Then there are PHEV, that's plug-in hybrid vehicles. They are quite similar to hybrid vehicles, but they can be plug-in charged and it gives them the ability to drive solely on battery for shorter distances without using the combustion engine. However, the numbers suggest that this is not a popular option. Then comes our electric vehicles, and they don't have any combustion engines, of course. It runs solely on batteries.
For any profound change to happen, we have always seen that public and private sector have to work in unison. In transition towards electric transport as well, the governments all around the world are launching subsidies or tax breaks either to car manufacturers or consumers. Australian government have launched Future Fuel Fund, which is about $250 million, which will help to build charging infrastructure with private players.
Let's go through how electric vehicles track up against ICE cars. In 2020, only 0.78% of all vehicles sold in Australia were electric vehicles. That comes to 6,900 vehicles. Last year, that figure went up to more than 20,000 cars. Electric cars have been around for some time, as you said, but the sales started to pick up after 2016 when it reached 1 million units mark globally. Since then, the growth has been phenomenal, and today we have surpassed more than 7 million electric vehicles globally. As expected, Norway leads the pack with 74% of all vehicles sold with electric, followed by China, North America, and Europe.
When total life cycle of electric car is taken into account, it is far from carbon neutral. Considering greenhouse gas emissions for manufacturing to electricity source for charging, coal or gas power plants supplying your local grid, to energy efficiency of the battery on which the car runs. But this equation is slowly changing. Polestar, an electric offshoot of Volvo, has pledged to build a complete carbon neutral car called Polestar Zero by 2030. Audi e-tron manufacturing plant in Brussels has already achieved carbon neutral assembly line completely powered by green energy and has been awarded CO2 neutral production certificate in 2018.
So you are saying that even 100% electric vehicles are not completely zero carbon solutions?
No, they are not. Because we have to take into account the power required for manufacturing as well as raw materials which are used inside them. According to US Environmental Protection Agency, average passenger car emits 4.6 metric tons of CO2 per year. There are more than 1 billion cars on road. Going by those numbers, road transport on an average makes up about 15 to 30% of CO2 emissions per year, depending on number of cars in each country. According to US Department of Energy, Electric vehicles convert 77% of their energy in batteries to power at the wheels, whereas internal combustion engine convert 12 to 30% of their energy from petrol to power at the wheels.
Let's compare the greenhouse emissions of Toyota RAV4 and Tesla Model 3 based on Wall Street Journal and University of Toronto research. Imagine I have just bought a RAV4.
And I have bought a Tesla Model 3.
At the time of buying my RAV4, I have already racked up 7.4 tons of CO2 thanks to its manufacturing process.
And my Tesla has consumed 12.2 tons of CO2 due to the minerals consumed in the battery manufacturing. That is 54% more than your RAV4.
Whoa, my RAV4 is winning so far. After driving 5,000 miles, RAV4 is at 9.2 tons, requiring oil change and gasoline to run.
My Tesla has barely contributed anything, and at 5,000 miles, it's at 12.8 tons.
Ooh. At 20,600 miles, your Tesla has caught up with RAV4, and both of us are sitting at 14.7 tons.
At 36,000 miles, my Tesla is at 16.6 tons.
Damn, this is a losing battle for my RAV4 with 20.1 tons.
At 100,000 miles, Tesla is at 24.2 tons.
Okay, I'm gonna stop driving my imaginary RAV4 as it will be emitting 42.7 tons of greenhouse gas emission.
Then you don't want to hear this. But at 200,000 miles, your RAV4 would have reached 78 tons. That's 100% more than my Tesla Model 3. Another potential advantage of EV is vehicle to grid charging, which is a compulsory inclusion for every vehicle sold in Japan. Nissan Leaf is already doing that in UK, where spare unused electricity can be sold back in the grid. Your EV can become a mobile battery which can be used to power your house, reducing your power bill. So basically, charge using solar panels and use the whole car as a power storage. There is an Australian startup called JetCharge who is working on these solutions. Volkswagen Group, which includes Audi, Skoda and Porsche, has said all its electric vehicles will have vehicle to grid by next year. Canberra is currently staging one of the world's largest vehicle to grid trials, a 6.6 million exercise involving 50 Nissan Leaf cars. Powered by Active AGL, the Australian Capital Territory Government, JetCharge and Australian National University. The project is called REVS, Realizing Electric Vehicle to Grid Service, and it's closely examining how fleets of EV could be used to help support the electricity grid and to stabilize it during periods of high demand. Where do we stand in terms of charging infrastructure? Can you throw some information on it?
Charging infrastructure is one of the crucial pieces for rapid uptake of electric vehicles. So Biden administration recently announced that they plan to spend $5 billion to build EV charging networks across US with the aim of having one charging station every 50 miles on interstate highways. Charge points, formerly called Coulomb Technologies, arguably has the world's largest network of EV charging points. It claims to have more than 100,000 charging stations across 14 countries. BP has been in the business of EV charging station for some time now. In UK alone, they have more than 11,000 charging stations. So far, it was seen that filling up the car with electrons is a loss-making business as compared to filling up a car with petrol or diesel. However, in UK, BP has seen the profitability margins for these charging stations are nearing the same as the petrol ones. That's really a turning point for charging infrastructure. Here in Australia, there are now over 3,000 public chargers installed across 1,600 locations. Out of these chargers, 470 are DC fast or ultra fast chargers as we call it.
Key factor that is pulling Australia back in terms of massive uptake of EV is range anxiety and lack of enough charging infrastructure to drive around such a vast nation. There are two main charging types of an electric vehicle: alternate current, which delivers a slower charging rate and the same current you use at home, and DC or a direct current, a faster charging capability used for on-the-go charging. And it is this DC charging or fast charging rollout is paramount for mass uptake of electric vehicles.
This challenge is a bit unique for Australia, especially because of the size of the country. In some remote areas, it's difficult to even find petrol stations, let alone EV charging stations. People carry jerry cans when they drive long distances.
You must have noticed that cost of a regular unleaded 91 or 95 increases as you drive countryside due to extra cost loading required for fuel transportation from major ports.
Agree. So, are there any private players in this charging ballgame?
In Australia, there are few notable players. One is South Australia based Jolt, which is backed by BlackRock with 100 million fund, rolling out 5,000 DC charging stations, offering 7 kilowatt hour charging for free, which is enough to get you home, but charges apply anything that exceeds it. They have other source of revenue as well, like advertisements and charging at charging stations. There is EVIE, which have partnered with Tritium, an expert in DC batteries. Ampol, which is a traditional gas station player, is also rolling out 300 DC charging stations.
Besides charging infrastructure, there are some challenges for electric cars' supply chain, especially with the materials needed to manufacture batteries, not to mention the ever increasing microchip shortages that have caused impact throughout the auto industry, but especially for EVs, as they require nearly twice as many chips compared to non EVs. Another major concern for uptake of electric vehicles was a very limited vehicle choice. However, it's rapidly changing as every other car maker has stepped into this arena in the last few years. One of the emerging problems with rapid uptake of EVs is the lack of qualified mechanic workforce that needs to undergo rapid transformation as well. So, apart from charging infrastructure and range anxiety, the cost of EVs is major deterrent towards mass uptake. EVs still sell at a premium cost. How can this problem be addressed?
We all know that electric vehicles are not cheap. As EV industry achieves economies of scale, the cost of raw materials required for batteries is going to go down. Since last decade, we have seen that. Besides Australia, can go European Union way of slashing luxury car tax, import duty, stamp duty and GST on EV. All this is easier said than done as government will as it is be losing money in fuel cess tax, which they collect in petrol prices. The cess is used in construction and maintenance of roads. For example, Tesla Model 3 cost around $86,472. That includes $2,029 in luxury car tax, $7,857 in GST, $3,525 in stamp duty. That's about $13,411 of taxes. If all those are taken off, the car price comes down to $70,000 odd, which suddenly becomes a competitive to other petrol car versions.
When we talk about EVs, a lot of attention is given to passenger car segment. However, there is an increasing market for other vehicles like buses, heavy-duty trucks, motorcycles and scooters. There are now electric models available from Evoque, Harley-Davidson and a bunch of other companies. Electric bus availability has increased recently thanks to the government weighing in. Private sector demand for these zero-emission vehicles has seen significant growth as well. How can we not talk about mining when we are in Western Australia? The mining sector here is pushing towards more zero-emission vehicles as the industry seeks to reduce emissions and costs associated with underground ventilation. They have even resorted to converting utility vehicles by transforming them into zero-emission vehicles. FedEx, Amazon, Walmart all have committed to transitioning their vehicle fleets by 2040. Back here in Australia, Australia Post is the largest operator of electric vehicles with more than 3,000 EVs in its basket. How about other rental car companies? Where do they stand?
Even listed rental car companies like Hertz Global Holdings and Avis Budget Group have shareholder pressure to improve their green credentials. Hertz have signed up for 100,000 Tesla cars, which sent both their share price skyrocketing. Electric cars make up 2% of total cars in US at the moment, but it is projected to go 10% by 2025 and 30% by 2030, for which they have to keep up with the game for consumer demand.
Is subsidizing electric vehicles the only way to improve EV uptake, or is there any other better option available out there?
About 11% of Australia's annual emissions come from passenger and light commercial vehicles. Cars are usually kept on the road for at least 15 years. So, to reach net zero emissions by 2050, we need to stop selling cars that emit carbon by 2035. So, mandatory emission ceiling policy enforced by state as well as federal government can speed up EV uptake.
As the buzz around EV is growing, autonomous driving is also making quite a bit of noise in this industry. Companies like Tesla, Cruise, Aurora, Baidu, Didi are all pushing hard in this space. There are billions of dollars poured into autonomous driving. So, can you elaborate more on this?
According to Society of Automotive Engineers, there are 5 levels of cars. Level 0, no autonomous. Level 1, hands-on or shared control. Level 2, hands-off. Level 3, eyes off. Level 4, mind off. And level 5, steering wheel optional. In order to achieve these next levels, car companies incorporate different patented technologies in their models. High definition cameras, LiDAR technology, radar technology, etc. For instance, Intel's Mobila uses both combination of LiDAR and radar. Tesla solely relies on high resolution cameras. Then there is Google Waymo and Amazon Zoox, GM Cruise, Robotaxi, which uses LiDAR technology. Mercedes have got the permission to roll out its EQS Drive Pilot in Germany, which is level 3. That means, according to the classification, we can take our eyes off the road until car says you need its attention again. Tesla, which sells an add-on software full self-driving at $10,000 remote update, it is still officially classified as level 2. Needless to say, these classifications are very important from car and third-party insurance perspective.
That cost for Tesla has gone up to $12,000 now. So autonomous vehicles have had a bumpy ride so far. There are some teething issues with autonomous vehicles, especially around the liability and moral issues. But it definitely looks like the future where we are going. I can't wait to just sit back and relax as the car takes me through the freeway traffic in rush hours. But it does sound scary as well. I can see the autonomous vehicles will have a good appeal for public transport systems or heavy vehicles. There's numerous trials going around the world. Even in WA, RAC is running a trial since 2016. All this technology and renewed shift towards EV and self-driving cars is amazing. But finally, these businesses are still classified as heavy industrial ones, where the profit margins are always compressed and shareholder returns are hard to realize on paper. A lot of them are unprofitable for substantial period of time. Even after that, these EV companies are getting moonshot valuations. The traditional incumbents like Ford and GM, when they announce entry in EV market, their share prices ticked upwards. What could be the real reason behind this? Is it just the investor euphoria or there is something more?
I think we should not view these electric vehicle car companies as a traditional heavy industrial unit like General Electric or Enron. They are more of tech companies, and that is the reason why they have garnered lofty valuations. Tech companies are famous for upselling their products while their customer is already indoors with heavy profit metrics, either by software upgrades or add-on products. These new age electric vehicles will be doing the same. Say for instance you want an additional horsepower or upgrade your autonomous drive level, pay for it or subscribe it and car will perform better. So in essence, the original car that you will be buying will be top end model with locked features. Stellantis, maker of Jeep, Dodge and Chrysler, have predicted by 2030 software and upgrades will contribute $22,557 billion in revenue. Even GM have that figure sitting at $25 billion.
We know that Rivian has lost over $1 billion in the last year based on its recent S1 filing with the SEC. With high valuations come high expectations, and so far, Tesla is one of the only companies that's proven it can make a profit building electric vehicles. Eventually, all of these manufacturers will have to prove they are able to build and sell vehicles profitably, and that's going to be the hardest task they've faced. Whenever any new industry or business comes into being, it's heavily guarded according to its ESG credentials. Besides, EV industry itself is born out of the need for shift away from the fossil fuel vehicles. As the age of EVs is upon us and batteries are the heart of EVs, there is significant research going on in battery tech. It really deserves its own episode as there's so much to talk about it. Lithium ion is by far the most popular choice among EVs. They have high energy efficiency and low self discharge levels, and they do perform at high temperatures as well. Australia is one of the world's biggest producer and exporter of lithium. Can we briefly talk about batteries used in EVs?
On an average, an electric vehicle sedan takes a 23 kilowatt hour battery. Merely in 2010, the cost of battery was hovering around 1100 kilowatt hour. So back then, if you build an EV, $25,300 will just go into battery. Today in 2022, battery still makes up the dominant substantial cost of electric vehicle, but the average cost has fallen to $130 per kilowatt hour. But as you know, 2022 came with two headaches: supply chain issues and rising inflation, and now war, which in turn had a negative effect on raw materials required for battery manufacturing. And ambitious $100 per kilowatt hour cost is still a distant dream. Now prices are soaring for the key ingredients in batteries. Battery grade cobalt prices are up 119% from 1st of Jan 2020 through mid-January 2022. Nickel sulfate gained 55% and lithium carbonate rose 569% according to benchmark. Other related industry which is quite talked about is semiconductor, which is the heart of these fancy cars. And since the beginning of this pandemic, we are facing massive shortages of semiconductors, to an extent that China might flex its muscles over Taiwan, as Taiwan Semiconductor Manufacturing Corporation, the biggest semiconductor manufacturer, is located there, which have very established supply chain contracts.
Now we know quite a bit about electric vehicles. Let us find ways of how we can monetize this trend with our investment dollars.
While talking about investment, there are many areas which you can explore when you take electric vehicle theme as a whole. Starting from supply chain to raw materials, battery technology, EV manufacturing companies to basic minerals required in their makeup. By listing all these avenues, our main goal is to avoid parochial attitude towards this theme. And it is up to the individual investor to find value or potential growth businesses in any of these areas. For the sake of simplicity, I will deep dive into financials of major car manufacturers who have chosen to go ahead with electric vehicle, which pretty much all of them have, to some Australian and US listed exchange traded funds. Let us deep dive into Mercedes-Benz Group, formerly called Daimler, formed by merger of Mercedes and a British company Daimler. Who doesn't know Mercs, a very reputed and respected German brand operating since 1926? Recently, they created a lot of buzz when they launched Vision EQXX concept car offering a range of 1000 km plus and power consumption rate less than 10 kilowatt hours of energy per 100 km. It plans to build it within 18 months. The new battery will comprise silicon anodes and lightweight materials and deliver 20 watt hours per kilogram. Additionally, EQXX will draw power from solar cells on the roof. By 2030, the company says it will be ready to go all electric. In 2020, the truck and bus business, now called Daimler Truck AG, accounted for 23% of consolidated revenue and 8% of group's adjusted earnings before interest and taxation. Economic profit of the car group since 2006 has been 12.5 percentage points. Mercedes-Benz Group with a ticker MBG is listed on Frankfurt Stock Exchange with a market cap of 79 billion euros, currently trading at 74 euros per stock. MBG offers healthy return on equity with about 21% with a free cash flow of 17 billion euros in fiscal 2021. Mercedes-Benz Group works on 6.9% profit margins. Mercedes-Benz Group debt to equity ratio is on a higher side with considerable debt on its balance sheet. Weighted average cost of capital, which includes cost of equity plus debt, sits at about 8.4% for MBG. The group also commands high credit rating. MBG has consistently given the return on invested capital of over 10.3% since 2006.
And Mercedes-Benz Group has planned to commit $110 billion by 2025 towards just electric vehicles initiative.
Next is Volkswagen, ticker VOW, another famous German car maker. After their defeat device scandal and resignation of CEOs and reshuffling of executive committee and board members, they are trying to clear off their name and reinvest and reinvent themselves as electric car pioneer. Volkswagen with a market cap of 127 billion euros and currently trading at 255 euros, listed on Frankfurt Exchange. You can buy both stocks for MBG as well as Volkswagen in OTC in secondary US markets. The Volkswagen Group sells passenger cars under Audi, Bugatti, Cupra, Lamborghini, Porsche, Seat, and famous motorcycle brand Ducati. They also sell heavy commercial vehicles under the subsidiary Traton. By 2022, the company expects to have 27 battery electric vehicle models derived from MEB called Modular Electric Toolkit. In plain English, in 2025, Volkswagen Group will be introducing Volkswagen Operating System, a digital software program on which all the models will run. Developed by internal CarrierEd Software Group, the company believes that its shares of in-vehicle software will climb from 10% in 2020 to 60% for vehicles launched on Scalable Systems Program architecture, similar to what we discussed with Stellantis and General Motors. Volkswagen Group operating under 8.6% weighted average cost of capital, have an average EBIT margin of 7.5%, which should gradually expand as they shift towards software update model. Volkswagen is embroiled in Dieselgate emission settlement, which is estimated to run around 10 billion euros. Volkswagen return on invested capital exceeds weighted average cost of capital by 1.4%.
Volkswagen has made some steep commitments. By 2025, they want to produce 1.5 million EVs across the Volkswagen Group, and by 2028, they have planned to have 70 new EV models with an investment of 86 billion over the next 5 years, and they plan to go carbon neutral by 2050.
Now next is Tesla. Whenever we talk about Tesla, we get a lot of attention in every social gathering or a party. Let us quickly deep dive into Tesla's financials. Tesla is the largest battery electric automaker in the world, forecasted to deliver 1.5 million vehicles in 2022. Its sales in resale invest 5% in research and development. Tesla's total vehicle volume has grown from over just 100,000 in 2017 to nearly 600,000 on a trailing 12-month basis as of the first quarter of 2021. During the same period, the company's average cost of goods sold per vehicle has fallen 55%, from 84,000 to under 38,000, and gross profit margins have expanded from 23% to a little under 27%. Tesla is run by Elon Musk, who doesn't know him, who owns 21% of Tesla stock. Under the current plan created in 2018, Musk can earn up to 101.3 million stock options awards, split adjusted at a price of $70 per share in 12 tranches based on meeting revenue, earnings before interest, taxation, depreciation and amortization, and market capitalization targets. Next in line is Toyota, well-renowned Japanese car maker. Toyota has been selling internal combustion engine as well as hybrid cars for quite some time now. Toyota is largest car manufacturer in the world with a market cap of 310 billion USD. Toyota is thinking about the future with its Monet autonomous vehicle service joint venture with SoftBank and other Japanese automakers such as Honda. Its battery joint venture with Panasonic and Woven City, a laboratory city of the future in Japan, run on hydrogen fuel cells. Toyota is also working on solid state batteries and has 69 billion electrified vehicle plan for 2022 to 2030. It targets Lexus being 100% battery electric vehicle in North America, Europe and China by 2030 and Lexus 100% battery electric vehicle globally by 2035. Toyota is buying back stock. Since 2015, it has reduced its dilution by 10%. Let us move forward to Ford. Ford seeks at least 40% global all-electric volume by 2030 and global battery electric vehicle capacity of 600,000 by 2023. Ford is mainly focusing on light trucks and off-road vehicles like Bronco and has invested $30 million on all-electric vehicle by 2020 to 2025. Finally, we will move on to General Motors, considered predominant player among big three of Detroit, selling popular brands like Chevrolet, Buick, GMC and Cadillac. GM is investing over $35 billion in battery electric and autonomous vehicles by 2020 to 2025 and is launching 30 battery electric vehicles through 2025 with two-thirds of them available in North America. Management also targets over 1 million annual BEV sales by mid-decade and early 2021 announced the ambition to only sell zero-emission vehicles globally by 2035. Autonomous features such as Super Cruise or Ultra Cruise should enable margin expansion over time.
This massive shift towards electric vehicles stimulates a lot of other industries like semiconductor, batteries, lithium miners, autonomous driving technology, and various other components. And if you want to jump in on this mega trend, you can invest into one of the companies that we just went through, like Tesla, GM, Volkswagen, or Mercedes-Benz Group. Or you can make use of one of the thematic ETFs. Here in Australia, we recently got one of the first electric vehicles based ETF by Beta Shares. Electric Vehicles and Future Mobility ETF with ticker DRIV. There is a Global X Autonomous and Electric Vehicles ETF with the same ticker DRIV on Nasdaq as well that focuses on EV suppliers. If you want to capitalize on battery tech, as we had mentioned in one of the previous podcasts, there is Battery Tech and Lithium ETF with ticker ACDC on ASX. Then there is Amplify Lithium and Battery Tech ETF on NYSE with battery BATT. We have seen that battery tech powered cars, motorbikes and even heavy duty vehicles are slowly but surely making inroads into the mainstream transportation industry. EVs are on top of everyone's mind thanks to the advancement in battery technology as well as the renewed focus on charging infrastructure coupled with the need for zero-emission transportation. Currently, EVs sit in the premium price range. However, the way market is growing, it will be just a matter of time that their price will be in parity with petrol vehicles. With massive investments from traditional auto manufacturers and new entrants, the EV boom is here to stay. On that note, it's time to wrap up today's show. Thanks for listening to our episode.
This recording is for informational purposes only and does not constitute an investment advice. Opinions expressed are as of the date recorded. Opinions are subject to change. Capital Trends Media shall not be responsible for trading decisions, damages or a loss resulted from or related to information, data analysis or opinions expressed on this podcast. Past performance does not guarantee the future results. All investments are subject to market risk including potential loss of principal. Please read product disclosure statement before investing into any product. We are not professional financial advisors. Do not take investment or financial advice from our podcast. Always consult a professional financial planner regarding advice that suits your individual needs, which you can find on ASIC, APRA website in Australia.